A couple of days ago, I saw a tweet on X from this guy called Peter Levels, who's a pretty famous indie developer. In the tweet, he said he put together an investment portfolio based on a super random filter, whether or not the company's CEO does weightlifting. Then he backtested it and found out that over the past 4 years, his ETF outperformed the S&P 500 by 2.4 times. He even joked that if Google's CEO did weightlifting, Google's performance over the past few years would have been better. Obviously, it's a joke, but honestly, after reading it, I kinda wished he was serious. This tweet reminded me of an important idea I came across before. The S&P 500, which so many of us rely on, actually has flaws. And because of these flaws, you could technically create tons of portfolios that outperform the market and beat 90% of investors, even if the selection criteria are as ridiculous as the one in this tweet. So in today's video, I want to talk about what's really wrong with indices like the S&P 500. Why is it that, in theory, anyone can beat it, but most of us don't try? And instead, we all just stick to market indices like the S&P 500. Before understanding the flaws of market indices, you first need to know, when we say we're investing in the S&P 500 index fund, what exactly are we buying? Many people will say it's 500 stocks. And while that's not wrong, it doesn't really address the core of the question. The real issue here is, when you invest in an index, you're investing according to how the index selects and weights the stocks. Let's say you have $100 to invest in the S&P 500. How exactly do you allocate that $100 across those 500 companies? Do you split it evenly, like 20 cents per stock? Or do you give more to Apple and less to Nvidia? The S&P 500 uses a market capitalization weighted method, and it's really just a basic math problem. It takes the market cap of each company and divides it by the total market cap of all 500 companies to get a percentage. That percentage is the stock's weight in the index. So when you invest in the S&P 500 index fund, your money gets allocated according to those weights. Because the S&P 500 is weighted by market cap and includes the 500 largest companies by market value, it's often seen as a good reflection of the overall market. Other indices, like the Russell 3000 or 1000, work similarly. When we talk about beating the market, we're usually talking about outperforming these indices. Now that we understand what investing in the S&P 500 really means, we can get to the main question: what's the flaw of the S&P 500? I think it's pretty easy to understand that the price movements of companies with higher weights in the index have a bigger impact on the index overall. Since the S&P 500 is market cap weighted, that means the bigger a company's market cap, the more it influences the index's performance. For example, we all know that right now around 30% of the S&P 500's weight is concentrated in just a few big tech giants. If they make any sudden moves, the entire index tends to follow. But why is this a flaw? Well, everything has two sides. The market cap-weighted structure of the S&P 500 does a good job of representing the overall market performance, but it also mirrors some negative aspects of the market. For instance, the market isn't always rational. Stocks are often overvalued or undervalued. Some people argue that tech stocks are currently overvalued and that we're in a bubble, while stocks in other sectors are undervalued. Now, this overvaluation and undervaluation don't last forever. Over time, the market usually corrects itself, and prices tend to return to their fair value, what we call mean reversion. This adjustment process, however, can negatively impact a market cap-weighted index like the S&P 500. When overvalued companies, which have a disproportionately large weight in the index, start to drop in price, it can drag the entire index down significantly. On the flip side, when undervalued companies rise, the positive impact is smaller because they have less weight in the index. This imbalance can lead to suboptimal long-term returns for the S&P 500. Take the dot-com bubble in 2000, for example. When the overvalued tech companies crashed, it caused the S&P 500 to take a big hit. That's one of the weaknesses of the S&P 500's market cap weighting system. So at this point, some clever people might think, what if we ditch the market cap weighting and use a different weighting method to build an index? Could that help avoid this flaw and actually beat the market? In 2013, a group of researchers at the UK's Cass Business School conducted an interesting experiment called the monkey random stock picking test. The reason it's called that is because it's based on a famous concept known as the infinite monkey theorem. This theorem suggests that if you give a monkey enough time to randomly hit keys on a keyboard, it could eventually type out the entire text of Shakespeare's Hamlet. While that sounds incredibly unlikely, Theoretically, it's possible. The philosophy behind this is that randomness can sometimes lead to order. So how did the researchers apply this monkey theory? They simulated the process of 10 million monkeys randomly picking stocks. Each monkey would select stocks at random from the top 1,000 most valuable stocks to create an investment portfolio. To avoid the pitfalls of market cap-weighted indices, they used a unique weighting method. After each stock was picked, the researchers assigned it a small weight of 0.01, then put the stock back into the pool for the monkey to potentially pick again. This process repeated 1,000 times. As a result, some stocks could be picked multiple times, while others might not be picked at all. For example, if stock A was picked twice, its weight would be 0.002, and if stock E was picked 10 times, its weight would be 0.01. While it's technically possible for a stock to be picked 100 times, giving it a 10% weight, that probability is extremely low. This random weighting method introduced an element of randomness, while minimizing the risk of over-concentrating in a few stocks. The experiment covered 42 years, from 1968 to 2011. To make the comparison fairer, the researchers set two additional rules. First, the monkeys had to pick stocks once a year. This was to more accurately simulate how an index fund operates, where the components and weights are adjusted regularly. Just like the S&P 500, where companies are added and removed over time, the monkeys' yearly selections mimicked that rebalancing process. Second, since the monkeys were picking from a pool of 1,000 stocks, the researchers used an index that tracked the same 1,000 stocks, rather than comparing it to the S&P 500, to serve as a benchmark. So what were the results? It was found that if you had invested $100 in a fund tracking this 1,000 stock index in 1968, by 2011, that investment would have grown to around $4,800, with an annual return of about 9.65%. But the monkeys? They did even better. Half of the monkeys' portfolios ended up with values over $8,700. 25% of them exceeded $9,100, and the top 10% of portfolios even surpassed $9,500. The researchers discovered that almost all the randomly generated portfolios outperformed the market index. And remember, we're talking about 10 million monkeys here. This result got people thinking, if even a random monkey's portfolio can beat the market, could I do it too? In fact, Wall Street had already been thinking along the same lines. Many firms began using various weighting methods to create index portfolios in an attempt to outperform the market. Since even a random monkey-picked portfolio can outperform the market, you don't need a fancy degree or a high IQ to invest. In fact, these monkey-selected funds have outperformed most of Wall Street's funds. So only a very small number of truly skilled investors might be able to beat the market over a certain period. That's the point of this video. It's actually possible to find a portfolio that beats the majority of investors. But most people don't have the guts to invest in it, and that's why most people can't beat the market. The reason for this isn't about numbers or calculations. It comes down to human nature. Most people's investment decisions are driven by short-term uncertainty, and we're all vulnerable to that uncertainty. Now, if we look back at this monkey experiment report, we can see that the comparison between random portfolios and index funds was very inconsistent. It wasn't that these random picks outperformed the index over the full 42 years. There were phases of both outperformance and underperformance. For example, from 1975 to 1986, almost all the random portfolios did better than the market. Which sounds great, right? If you had invested in one of these monkey portfolios, you'd feel pretty smart. But in the early 70s, or from 1996 to 2001, most of these monkey portfolios actually underperformed the market. As an investor, you might find it tough to resist the psychological impact of these phases of uncertainty, and that could lead you to abandon the monkey portfolio and switch to the popular market indexes. Specifically, these psychological influences can be broken down into three key factors. First, there's the fear of risk. Even when investors are making money, if their returns are below the market average, they often feel like they're losing out. This triggers a natural aversion to risk. The thing about risk aversion is that the pain of a loss feels much worse than the joy of an equivalent gain. So, it's tough for people to deal with underperforming the market, even if it's just temporary. Second, there's the comparison factor. Nowadays, a lot of individuals and institutions are investing in index funds like the S&P 500. If your investment isn't doing as well as the market, social comparison kicks in, and you feel an immense amount of pressure. You might start doubting yourself, or even face criticism from others. Take Cathie Wood, for example, the founder of ARK Invest. She used to be hailed as the female Buffett when ARK was doing great. But in recent years, ARK's performance has been poor compared to the market, and now people criticize her harshly. It's tough to resist the social comparison, and no one wants to look like a fool in front of others. So many people just follow the crowd and invest in the market index. It feels safer. After all, if the market goes down, at least everyone else is losing too, which gives a bit of comfort. Third, there's the pursuit of certainty. An index like the S&P 500 gives investors a sense of security. It reflects the overall performance of the market, and many people believe that the market's performance is linked to long-term economic growth. If someone believes in the long-term growth of the economy, it's easy to believe the market index will also grow over time. In contrast, a strategy like a monkey portfolio doesn't reflect the whole market or the economy. It feels random and unreliable, and people are naturally skeptical of that. Because of these factors, even professional investment firms find it hard to stick to portfolios that could theoretically beat the market in the long run. If they underperform the market, clients complain. They might say, "The market's soaring and your portfolio isn't even keeping up. And on top of that, you're charging me fees. I'd be better off just buying the index." As a result, many investors pull out and funds often disappear before they have the chance to prove their long-term value. So, even if Cathie Wood is the female Buffett, she may never get the chance to prove it. She's not losing to the market, but to investors' fear of uncertainty. As the saying goes, people don't want wisdom, they want certainty. Alright, at the end of the video, our biggest enemy in investing is really ourselves. So how should we, as investors, deal with uncertainty? If you're interested in this topic, make sure to like and comment on this video. That way I can gauge whether creating follow-up content has a reasonable return on investment. Thank you for watching, and I'll see you in the next video. Bye.